Benchmark Business Sales and Valuations proudly presents the Meaning Business Podcast, hosted by Bruce Coudrey and Peter Spinda. This is the podcast for anyone serious about buying, selling, and preparing your business for maximum growth.
One of the things that we notice in Benchmark in selling businesses is that most business owners don't plan to sell their business. They rush in at the last minute, unprepared, and just say, I want to sell and give me a buyer.
It's one of those things where I own a bakery, I'm baking every single day, and I'm just baking, but I'm not really thinking about, well, what's the purpose? Where am I going? So many people fall into that trap.
Exactly.
And then what happens is life happens, they get sick, their partner gets sick, or something happens in life, and they need to exit. And it becomes this rush, this last minute, unprepared situation.
Exactly.
And instead, what we're saying is, let's take the planned approach. What would happen if we actually paused and started working on the business?
Yeah.
Talk to a business broker early on in the piece so that you understand, well, what do you need to do in order to get the maximum value for the business?
Yeah.
Just leading at last minute.
No. So many people live day to day, moment to moment, hour to hour. They're so swept up in doing the daily things that are either urgent or important, and they don't really think about the end result, which is planning for the succession. And if they do that, they're going to get a lot better results. So sadly, very, very few people do that. So easy. So I just said urgent and important. So everyone's dealing with the urgent and they're not dealing with the important. And this is probably the most important thing. This and it will, probably some of the most important things that people just don't do. They put it off and they don't think about it. But it's massively important. They're leaving money on the table. And unfortunately, in my many years of business sales, I see it all the time. And I'm sure you see it, Pete, too, where people just decide, I want to sell today. And they're leaving, lots and lots of money on the table, which is their retirement. So that could be the retirement.
So you've made a really good point. So we talk about this concept of leaving money on the table. What does that mean? So I think people need to understand that when you're in business, you can make money in two key directions. One is make money out of your business on the day-to-day of running it. Yep. Then there's the other type of money, which is the sort of money that you can capitalize on when you look at selling or exiting the business.
Yeah, exactly.
And you can actually impact how much money you walk away with at the end of the day. And I think that's what we're talking about. How much money you have in your super dependent on what you do today.
Yeah.
And people forget about that.
And the funny thing is that some listed companies or people go to private equity or to list their company with an idea and a plan and they've got no track record, but the whole aim there is to sell. Not to make money in the current day-to-day, but to get the balance right, to make as much money as you can today and to get your plan for your business sale and get as much as you can when you go to sell it. That's the ideal, right? Absolutely. Make as much as you can every day of the week, so you've got money in the bank, and then when you sell it, you get the premium price for your business. That's what we want. That's what we're talking about.
But it is, and so there's this fantastic booklet that Benchmark's produced called 12 Valuable Tips for Selling Your Business. So if anyone's watching the video, it's available on the website as well as a PDF. So I thought, Bruce, what we could do, if you don't mind, is we could flick through this and have a chat about the 12 tips for selling your business.
Yeah. So we'll take about 20 minutes, not long. And I think we should just go through and explain what those tips are from many, many years of selling businesses. We've kind of squished it down into 12 key things that we think are important.
Yep, absolutely. Now, as I said before, it's available on the Benchmark website as a PDF as well, but we'll just sort of have a chat about it. So tip number one is setting the right price.
Yeah.
What does that mean?
Okay, so we know that there's 4 things that determine how quickly a business will sell, and if we get those 4 things right, it will sell in 90 days. So the 4 things are getting the price right, having all the data collated and ready to go, so when you got to buy, you're not mucking around trying to find things, knowing who the buyers are and being proactive. Get those 4 things in place, you'll sell everything that we list within 90 days. But the key component to all that is the price. If you don't have the price right, you'll stall the sale. So, I could be selling a house in the suburbs where every other house is selling for a 900,000 or $1 million. And if I price mine at 3 million, it's just not going to get any inquiries. And then if I drop the price to 2 million and then $1 million, which is the right price, people are going to start thinking, well, what's wrong with it? Why have they done that? What's going on there? So to set the right price at the outset is very important.
And how do I do that?
Yeah, 2 things. So having an appraisal done is the best way to go. And in fact, if you're a business owner with no intention of selling, having an appraisal done by a business broker or a business valuer is a great idea, because every year you can check your net worth, you can check what your goodwill's sitting, and you can then set in play things that you can do to improve the goodwill. And there's two ways you can do that: improve profits or decrease risk. People always look at the profit side of it, but what's really important is the risk side of it. So by having an appraisal done, you can then look at how you can maximise the value through the multiple of earnings.
So does the appraisal tell me all of this information?
Yeah, absolutely. Yeah.
And how much does that cost?
Okay, so depending on what we get, it could be a business valuation, which starts at $5,000, and it's quite comprehensive. It's about 60 pages and takes about 2 weeks to get done. An appraisal is less comprehensive, but still gets you to a sale price, and importantly, talks about the things that you could do to enhance the value over time. So that's usually about $1,200. Could be a little more, could be a little less. People have businesses which are capital intensive, so we might need to do a capital plant equipment valuation. That's unusual, but it could be done, could be necessary. Or people might have 2 or 3 outlets or 2 or 3 factories or businesses under the one. So that's almost like doing 2 or 3 appraisals. So, but usually about $1,200. So the great thing about having an appraisal done is, if you get it done every year, it's quite easy to update, and we can then track how you're doing with that risk reduction. I'll give an example. So there's 17 things that we've identified that are risks. And if you minimise those 17 risks, you can enhance the multiple of earnings that someone will pay, the price that someone will pay for your business. So an example would be, if you're the key person, then your business is worth less. If there's no key person, your business is worth more. So eliminating a key person is an example. So in our report, we'll tell you what those things are. But if you don't get the price right at the outset, then the business will stall on the market. People will see it either too low or too high, and they'll wonder what's wrong. So what we're finding as we improve our technique and our results is that it's better to appraise the business really technically and properly, knowing exactly what the market's paying for the business, and set our price as offers above that price. So if you have a business and we appraise it at today's value at 3.3 million, and you decide, yes, I want to sell for 3.3, the best way to sell that business is to go with offers above 3.3 million. And the subtle difference is it stops the buyer from making an offer less than what you want, and it stops you from walking down on the price. If it's technically worth 3.3, then that's the price that we should get at least, and that's why we set our price that way. So the first thing is setting the right price. The best way to do that is to have an appraisal.
What's interesting, just before I get on to the next step, is so the appraisal gives me an idea of the value of the business itself, but it also gives me direction and pointers in terms of what I could do to impact that way.
Exactly. And interestingly, many people, too many people probably, know that and don't do it. But at least knowing it gives them the opportunity to take action. Now, probably the 5% that do an annual appraisal and look at the areas that they can improve, and of those people that do make those differences, they're going to add significant money to the bottom line. They're going to improve their walkaway price significantly over time. So coming back every year and seeing how they're tracking with that in conjunction with the accountant and other advisors is a really good thing to do. Great exercise.
So tip number 2 sort of leads on from that is look at your business through the buyer's eyes.
Yeah, so quite often we look at our business from our point of view, what we've done, how it operates, who our customers are.
My baby, exactly. Why my business is so bloody good. Yeah.
But, why would someone want to pay a lot of money? But, that's great, but we need to understand what buyers are looking at. And buyers are looking at a spectrum of business opportunities, not just your business. And how does your business compare with others? And what are they seeing when they look at your business? Are they seeing a business that's run down? Are they seeing a business that can't be improved upon? Are they seeing a business which is expanding or contracting? What are they looking at? So in this book, it says that what buyers want, they want to pay the right price, they want to be told the truth, they want future security, they want transparent accounts, they want simple management operation, they don't want to have to invest any more money in upgrades if they can avoid it, they want good presentation, they don't want to rely on key staff, no reliance on key customers, and none of the 5 negative attributes, which we'll talk about later. So if you think about your business from those angles and more, which we'll go through, then you can make adjustments to make your business look better to the buyer. Very important.
That's interesting. So we're on tip 2, and I'm already thinking, wow, this is so powerful. There's so many things that you can pull on from a lever point of view move forward and grow and impact the business itself.
And the key thing here, and it says it here, is that, you only get one chance to make a first impression. And first impressions are really powerful. So if someone comes to your business and they don't get a good first impression, there's no coming back from that, really. So that's why we need to look at the business from the buyer's point of view and try and make that first impression a strong one.
So that's why we need to plan. Go into this in advance and don't.
One of the many reasons why.
Yeah. So tip number 3, like you said before, the negative attributes. So what are the 4 negative attributes?
Yeah. So nearly every business will have at least one of the negative attributes, and sometimes all 4. If we can reduce or impact those negative attributes, we're going to make the business much more sellable. In other words, people will want it, and potentially more valuable as well. So what are the 4 negatives? Well, you've got to get the book to find out.
I could read it out.
Well, I'll tease you with one.
Sounds good.
Working capital. So the ability to push down, reduce the working capital requirement that a buyer will have. That could be by reducing debtors or stock or work in progress. If you can manage that, and by managing that, you'll make your business more valuable to the buyer and more desirable.
Okay.
So yeah, there's 4 negative attributes, and if you can manage.
So download the PDF and you'll get the other attributes.
Exactly, it's pretty simple.
So tip number 4, eliminate the key person.
Yes.
I mentioned before.
So spoken about before, right? Now, some businesses, particularly in professions like doctors and lawyers, you are the key person. So you can't really eliminate that key person, but what we can do is we can plan to sell by earn-out or retention. So if you're a doctor and I want to buy your practice, and I take over tomorrow and you leave, patients probably go with you, patients. But if we have an earn-out or retention where you stay on and you transition out while I transition in, and I pay you according to how many of those patients stay on, then that's a better outcome for everybody. And that's another one of those planning situations. So it's not just about eliminating the key person, it's about addressing this whole idea of the key person. That might also be, let's say you're in an engineering business and it's Peter Spinda Engineering. That name, that brand is good for you, but it's no good for anybody else in the world. It doesn't mean much unless you're an Elon Musk, I suppose, which is not really going to happen. But if we change that business name to a generic name, which makes a statement or sounds catchy, that could probably enhance value as well. So it's not just about eliminating key person, but also all the connotations that go around that. How we sell it, how we brand the business, those sorts of things.
So by thinking about things from that perspective, it also means that people who may have traditionally walked away from business thinking, well, I'm just going to shut it down. So it's not sellable.
Yeah.
It's probably sellable.
Absolutely.
Probably is something in there.
Yes.
They just need to talk to someone who understands it, who can guide them and provide them the right advice.
Interestingly, so we meet a lot of people who've got businesses, and some people think their business is worth more than the market's prepared to pay, and some people have a realistic view. And some people think their business is worth nothing and do shut it down, but it's actually worth significant money. And the other thing that can happen is sometimes people can get themselves into trouble with debt or owing the tax office GST or tax, and they think that they've got to declare bankruptcy or get insolvency practitioners in, and that may not be the case either. So you've got to understand the position, and we can really enhance value by doing those sorts of things.
Talk to someone early.
Yeah.
Tip number 5. Now, this is a really interesting one. Very interesting from many angles. Football revenue through the books.
Not as big an issue today as it used to be, but still an issue. So back in the 90s and 2000s, it was a common and popular thing for business owners and tradesmen to get paid in cash, to pay cash, and to put the cash in their pocket and not declare it as income and reduce tax. But when you're a buyer buying a business, if someone's got no income on the books, if it's in their pocket and they haven't declared it, then how can you trust them, right? So fortunately, with the reduction of cash payments in most businesses and the increase in credit card payments, it's much easier for buyers to measure sales and verify the sales. But if you've got a business where you're putting cash into your pocket, you've got to stop doing it, put the cash through the business, inflate the sales figures on your accounts, and you'll get more money for your business.
So I've seen businesses try and do different things like open up an eBay store or Facebook Marketplace, listing things for cash as if it was a personal sale.
Yeah, Gumtree.
Shifting things.
Yeah,
So
not worth it.
Look, you might get that short-term gain, if I can put it that way, but it's definitely not worth it for many.
Correct, exactly. It's not just about, it's not worth it, from the sale of the business point of view. You'll get more money if you put all the cash for the business. But also, if you want to borrow money, you're not thinking about selling. You just got a business and you want to go to the bank and borrow money to buy a new home or a car or a boat or whatever, and your figures don't show the cash that you're putting in your pocket, and you can't go to the bank manager and say, "Oh, I'm also pocketing $30,000 a year." They're not going to. They're going to ignore that, right? So, for many, many reasons, it's the right thing to do. It's not just about selling your business, but these days it's a lesser issue than it used to be. But we still like to make sure that everyone puts all the money through the till.
So how much will someone pay for your business?
Yeah.
Number 6.
Yeah. So this explains a lot about value, what creates value, how value is assessed, and so on. So it's a good one to read, this one. But essentially what we're looking at is, what is your business really worth? How does the market determine what your business is worth? So this is a really weird dynamic, by the way, Pete. So you can have a business sector where there's high supply and low demand, and prices are still high, which is weird. You can have a sector where demand is really high and supply is low, and usually prices are high. But you can also have it where the prices aren't so high, perhaps. So it's not just supply and demand, it's also about what the market's doing right now. So what we like to do, this is all about getting your business appraised and valued. It's back to that sort of thing, really. It's just a bit more in-depth about how we get to that. And it's about business owners making sure that they're realistic about what they can get for their business. So we spoke at the outset about setting the right price. This is a bit more about understanding why the price is where it is. It's about understanding the market and accepting what the market reality is. The market is the market, and the market is always correct. The market varies from state to state as well. But a news agency used to sell for big money in the 80s and 90s. Now they're much lower value. Why is that? That's because the market doesn't see the value there that it used to see. So
So could this be almost like a beacon or something like that sort of says to a business owner, hey, your industry's changing. Be aware that if you don't act now or don't do something now, you're going to lose value. It's going to be harder to sell.
Yes.
Or it could be for another business owner, might be, buy to move into that sector or transform the business because there's some big growth coming, which means that your value is going to increase.
Exactly. Or it could be that you are in hospitality and you didn't adopt Uber Eats and takeout and delivery, and maybe you need to do that. Many areas that can determine what someone will pay for a business. The other thing is, you could be in a business sector which is in growth, such as online sales are starting to grow now. It's taken a while, and reading this sector might say you can sell now for this money. If you hang on, you might get more. So that's another tip that we need people need to understand, is about how is the market for my business looking? Where was it before? Where's it going?
So then, going on to what we said before, plan. Again, you need to eye for that.
That's the ultimate plan.
Next one is security of tenure. So I'm assuming that's got to do with property. Is that what we're talking about, or is there something else?
Yeah, mate, predominantly. So not so much a big deal as it used to be, but still an issue. So if you've got a business where it's a retail business and a supermarket or a service station is a good example, or a childcare centre, and you've got a lease there, you don't own the property, before you go to the market, you need to make sure you've got as much tenure for that property or that location as possible. There's no good hospitality. This is a real issue. So a lot of people have a 5-year lease and they get down to 1 year left on their lease, and they'll decide it's time to sell. And they'll try and sell it on the premise that the landlord will offer the buyer a new lease. No way.
Doesn't always happen.
No way.
Wow.
To offer anyone anything. They're quite happy to leave the situation as it is. So why should they change it? So that's why it's better if you own a business in hospitality, for example, and you've got 1 year left on your lease, go and get a new lease. Or get an option, get an extent, exercise your option of whatever you need to do to get as much tenure as there as possibly can to be able to sell that business for the best price.
Number 8, what to be mindful of? And this has got many, many points here.
Planning. So we won't go through all of them, but this point 8 really just talks about, makes a list of all the things that we need to be mentally aware of to make sure that we're ready to sell the business. Again, it's totally all about planning. Planning for elimination of key people or employee entitlements or all the things that we've listed here, Pete.
This is just incredible. I'll just read a few out. But provision of full financial accounts for 3 years in balance sheets, prepare exit strategy or succession plan, calculation of net realisation after sale and CPT preparation.
Okay, so I'm going to stop you on that one.
Getting out of breath with all of this.
Yeah, that's a huge one. So just imagine that you decide to sell your business and we take it to the market and we get a buyer and the buyer's signed the contract and it's going ahead, it's unconditional. You can't get out of that sale. Let's say you're selling your business for $1 million, you bought it for $100,000. So you've made a $900,000 capital gain. Now you have to pay tax on that capital gain, that's capital gains tax. What if you don't know about it and all of a sudden before it settles, you're told that you've got to pay, say, $300,000 in capital gains tax out of your profit? If you'd known that, you might have treated the whole process differently. So this is where we need to plan and prepare, for example, for tax implications and the realisation of what you're going to do with the... And also people often forget about the payout of leases that they have or employee entitlements. So the calculation of the net realisation, what am I going to get if I sell the business for the headline price? What am I going to get left in my pocket? That's a really important one.
So you're basically saying just because you sold it for $1 million does not mean that you're going to get $1 million.
No way. You could end up with more, actually.
More?
Yes. Because in certain circumstances, you might sell it for $1 million. You'll collect your debtors and you'll pay your creditors, right? Now, if your creditors are $20,000 and your debtors are $300,000, you'll end up with an extra $280,000 on top of that $1 million. So you could end up with more, depending on the situation. But the whole point is we need to do that calculation of what am I going to be left with? That's important. So many people think, I want $1 million. They sign a contract to sell for $1 million. They don't get $1 million at the end because of all these costs and things. Legal costs, due diligence costs, you'll get your rental bonds back. So we need to do this plus and minus, debit and credit, to figure out this is what you should be left with after all the dust settles. So there's all these things that to be mindful of. You can pick any one of these. They're quite important. Elimination of work in progress and future orders. Ensure equipment, signage and plant equipment in good condition. They seem like obvious things, but just going through that checklist and mentally, or not more than mentally, actually planning for sale will save you so much time and money, and actually put money in your pocket. Now, these are things that we've learnt the hard way, right? Over many, many years, things have gone wrong, so we add it to the list.
That's a fantastic, almost like a shopping list of, okay, well, what do I need to do in my business today?
Yeah.
I like it. Tip number 9, spend or don't spend.
Yeah. Again, it's probably more related to the retail sector, but an example is if you're putting your business on the market today, let's say it's a childcare centre, and we assess the value at being $1.5 million. You might decide, it needs new carpet, or it needs painting, or it needs some new play equipment. Do I spend the money on it or not? So there's an argument that says you'll spend the money but you won't get any more for it. Or if you spend the money, you might get more, or you'll sell it more quickly, or you can claim the depreciation. So just doing that assessment about whether you spend or don't spend is a wise thing to do. Generally speaking, you should keep operating the business as if you're not selling it, generally speaking.
So act as if you're not going to sell it.
Generally speaking, yeah. But this is tip 9. So it's the 9th thing on the list is to just contemplate, do I spend money now or do I not spend money?
So tip number 10, we mentioned this a few times, have a plan in place.
Yeah.
Is this, so should I have a physical plan? Are we talking about a documented plan? Is it okay that's just in my head? What do you mean by this?
So there's more than this, but the basic 5 things are here. So did you read that out, Pete?
Okay. So Some steps that should be taken to create an exit plan are: have the business valued by a qualified business valuer.
Yep.
Calculate the current net worth.
Yep.
Plan dates and times for exit and projected debt realisation on sale.
Yep.
Formulate a plan and regularly check progress and performance against the plan.
Yep.
Can't see it in there.
So they're the basics that enable us to start a plan. But you know that whole thing that says here, failing to plan is planning to fail. So many people don't plan for the exit, the biggest pay day of the whole life of the business. No one's even given it a thought, you know. So just doing those basic things, understanding what the value is today, understanding where it could be, understanding the net worth. In other words, if you sell it for this and you pay out your debts, what do you get left with? What are you going to walk away? How does that compare with what it could be? You know. So this is the plan part. Yep. Really important.
So tip number 11, give yourself the greatest opportunity. Use a qualified business broker. Is there an unqualified business broker? Is that what we
Yeah, it could be, yeah, could be. Or it could be no business broker, or could be someone like unfortunately we've seen many circumstances where people who are qualified as an accountant or a lawyer have tried to sell someone's business, or a real estate agent. But they're not really professionals. A professional business broker knows all those things we're talking about here in the tips. There's a big list here of the things that a business broker will do and why you should use a business broker. So it's proven that a business broker, this is in the States, will usually see a value premium of 20% over what someone would get if they tried to sell it themselves, averaged out. So that's from the IBBA, the International Business Brokers Association. So there's no doubt that not only will a broker help you to maximise the value, or a good business broker should, but also make it more desirable and make the whole process quicker. As I said at the start, get those 4 things right, or 90 days we should sell.
Yeah, and I think given the fact that we've already gone through 10 tips, we can all see that there's so much to do. And as a business owner, I'm already busy enough, Bruce. So I think,
Yes.
you know, seeing this, I think most people will recognise that there is value in having a business broker on the team, just like you've got your accountant and your lawyer.
Yeah.
Have a good partner on the team that you can then work with.
Yep.
And as you said, it's a big asset as to your superannuation, to your retirement fund. Look after it and you can make more money out of it.
And you can look back and say, well, I paid a professional, I got the best price I could, I don't regret anything. The other thing is that a business broker doesn't get paid until the result's achieved. So it costs you nothing, basically, unless you get an appraisal paid. It costs you nothing to get that broker engaged, to get all the buyers at the table, get the best offers that you can get in front of you. That's what a broker does, and then you pay them when the result's achieved.
But even with your case, I mean, that's nothing in the scheme of things. You get tips and advice and things like that.
Right. Knowing what your business is worth is invaluable. For $1,200 or something, it's cheap.
Absolutely. So number 12, tip number 12 is advertise. You can't sell a secret.
Yes, so this is slightly... I've got to be careful about the wording here. So everyone wants to keep their business style confidential, and we want that too. Because in fact, what we found is if you don't maintain confidentiality, the value of the business is diminished. Yeah, by a significant amount. So maintaining confidentiality is really important. It's important for the staff, for the customers, and the value. So, but if a business owner is not prepared to invest some money in selling their business and marketing it widely to the widest possible audience, then they're not going to get the best price. So it's like selling a house. You know, in homes these days, at least 1% of the value of the property is put into marketing. And that's usually something like $16,000 for auctions. Well, it's the same with selling a business, except it's not $16,000, it's significantly less than that. So when you go to sell a business, you need to be prepared to spend a little bit of money on marketing the business to get the maximum audience to come and look at the business. Now, in the old days, you put an ad in the paper, and then papers became redundant and you put an ad on the internet. And up until recently, that's been the best way to go. We still do that. But in the future, it's about having a database and marketing to the database. And that costs money to organise the database and to market to that database effectively. So there's a cost there, and if you're not prepared to spend the money, you won't get the best result.
Okay. So basically, you've got two key costs. One is you work with the broker gets paid for managing the process and helping you. And the marketing is arms that gives them the tool or gives them the ability to get it out there and communicate.
Correct, that's right.
That makes sense.
Yeah. We're just paying for things that are tangible, and, you know, it's just covering the cost, like an information memorandum, or a database or marketing to the database, those sorts of things.
Now, I noticed at the back of the document that we've actually got 2 more tips. So you've got an extra tip and one more thing.
Yeah.
So we've got an extra tip, and I really like this one. Be 100% honest. I really like this one.
Well, the being honest part is not just about being honest to the person that's looking at buying the business. It's about being honest with yourself. So many of us don't want to admit that our business isn't perfect, and it sometimes is a bitter pill to swallow to realise your business isn't worth what you were hoping for. But if you're honest with yourself and you're honest with the people that you're dealing with, ultimately you'll get a better result than if you weren't honest with yourself. If you deceive yourself or you deceive others, the result will not be as good as it could have been. So we've just got to accept what the reality is and work with it, and that's the best way to go.
It's probably why we're going to go back a few steps and say, look, if you're not even thinking of selling the business, start the process now so that when it comes time to sell, you're happy with it. Yes, you're happy with everything.
Exactly.
You've done it right.
See, exactly. You'll look back and say, I couldn't have done it anymore.
Yeah.
That's right.
Yeah, man, you've got one more thing here. One more thing. As a seller, you want to ensure that the staff are not upset, suppliers or clients don't leave and go elsewhere if they find out that the business is for sale.
So what we're talking about here is the fact that a buyer should be happy to sign a confidentiality agreement, and so that sellers should not feel concerned about getting people to come and look at their business once they've got a confidentiality deed in place. So, and there is, each business is slightly unique, slightly different, but generally most protocols and provisions are the same, but business brokers should have the ability to discuss with the business owner how we're going to manage the sale. Do we tell the staff? Do we not tell the staff? When do we tell the staff? How much do we let the buyer know? What point do we let the buyer meet the staff or the customers or the suppliers? All those sorts of things, or the landlord. So we plan that, and we have what we call a sale plan. It's not just about doing those things, it's about determining if it's an asset sale or share sale is the best way to go. There's so many different parts to it. But yeah, that's another tip that's in this book, and it talks about that. And we also talk about where buyers come from, because a lot of people think that there's buyers coming from different countries at any point in time, and they're all coming here with big fat wallets and they just want money to throw around. So we explain in here where buyers actually come from.
Fantastic. So this is this is a fantastic tool. So again, it's the 12 valuable tips for selling your business. So found on the benchmarkbusiness.com.au website.
It's free.
It's free. Anything else that you wanted to add to this, Bruce? Anything else that we need to mention?
Yeah, I guess there's one more thing, Peter. That's 12 tips, and that's just what we've distilled over many years. But there's a lot of other things that a business broker can bring to the table when looking at assessing and preparing your business for sales. It's all about preparation. We don't want to list and sell your business today so we make a commission today. We want to take time over however long it takes to get the best price that we can. But so this is all part of that planning process, and there'll be other things apart from these 12 tips or general areas that will specifically apply to the business that a professional benchmark business broker can help you with. And the one thing that's great about benchmark brokers is they specialise. So we've got a team that does just service stations or supermarkets or childcare or hair salons or whatever, manufacturing, engineering, RTOs. They really know their stuff. So they'll be able to not just talk about these 12 tips, but they'll have other tips. For example, if it's an RTO, how we're going to manage the registration component, or the enrolments, or the teachers, or the curriculum. So there's so many components to it that this is just the basics. We have a lot more that we can help people with but when they engage with us. So thanks for looking at that, Pete. I think it's a really valuable thing. It costs nothing. It's but you know, over the years, so many business owners have thanked us for what they've learned in this little book.